Hey everyone, welcome back to Corporate Decoder, where we take boring financial reports and make them, well, less boring. And today we are diving into Triton International's latest filing, where it looks like they are making some big moves and things are definitely getting interesting. So today we're unwrapping Triton International's latest report. Think of it as a checkup for this giant in the shipping container leasing world. We're going to see how they're doing financially, what risks they're facing, and if they're still on top of their game. If you want to understand these reports like a pro, make sure you're subscribed and join our Discord community linked in the description. First off, let's peek at their balance sheet, which is like a snapshot of what the company owns and owes. As of June 30th, 2025, Triton's total assets were a massive $9.9 billion. That's a lot of shipping containers and everything else they use to run their business. Now, what do they owe? Their total liabilities were about $74 billion. This means they have quite a bit of debt, which is pretty normal for a company this size. But here's the good news, shareholders' equity, which is what's left for the owners after all debts are paid, was a healthy $2.5 billion. So it seems like they're in a solid financial position, at least on paper. Now let's talk about how much money they actually made from doing business, their income statement. For just 3 months ending in June, they brought in over $370 in total revenues. That's a big number, but it's actually less than the same period last year. They made about $378 million, $378 million, $358 million of that, $78 million. This drop, especially in operating lease revenues, is partly because they spun off a subsidiary called TCF the 8th. Think of it like selling off a part of the business. After all expenses and preferred dividends, the money left for the common shareholders was about $109 million for those 3 months. That's a good chunk of change, but again, lower than last year, which was around $64 million. So revenues are down, but so are profits attributable to common shareholders in this comparison. They also report something called comprehensive income, which includes things like changes in the value of certain investments that aren't in their day-to-day profits. For the 3 months, this was over $109 million. Interesting to see a jump here when their main income went down. Let's look at changes in the owner's stake. We see they issued a lot of preferred shares in February, bringing in $144 million. They also paid out a lot in dividends to their parent company and made a big distribution of that TCF the 8th asset. Basically, they're shuffling their equity around. Now for the cash flow statement, which shows where the money is actually coming from and going. For the first half of the year, they generated over $500 million from their operations. That's positive. Investing activities like buying or selling equipment brought in about $378 million. Overall, they ended up with more cash than they started with. Looking at financing, it's a mix. They borrowed a lot more and paid back less debt compared to last year, which explains the large positive number. It seems like they're taking on more debt, possibly to fund growth or acquisitions. On a side note, they've changed how they estimate the useful life of their containers. They're now saying dry containers last 15 years and refrigerated ones last 13. This change actually reduces their depreciation expense, making profits look a little better. They also had a big acquisition recently of Global Container International LLC. For about $1 billion, that's a massive deal for this company. A key risk they face is having too much business with just a few customers. Their top 3 customers accounted for 19% each of their lease billings in the first half of 2025. That's a lot of eggs in a few baskets. If one of those big customers has a problem, it could really hurt Triton. Back to that debt. They have about $6.6 billion in debt. A good portion of it, nearly 80%, is either fixed rate or hedged to be fixed rate. This is smart as it protects them from rising interest rates. If interest rates on their unhedged debt went up by 1%, it would cost them an extra $15 million per year. They're actively using financial tools called swaps to manage this interest rate risk, essentially locking in their borrowing costs. This is a proactive way they're trying to stay ahead of market changes. Triton operates in 2 main areas, equipment leasing, which is their core business, and equipment trading, where they buy and sell containers. Leasing is by far the bigger piece of their operations. Geographically, most of their revenue comes from Asia and Europe, making them very exposed to global trade trends. Looking at their income for the first half of the year, total revenues dropped by about $57 million compared to last year. A big chunk of that drop is from that TCF the 8th spin-off. But even after considering that, lease revenues are down, mainly because they have fewer containers on lease compared to last year. Depreciation also went down significantly, partly because of that TCF the 8th distribution, and partly because they changed their estimates for how long containers last. This lower depreciation is a positive for their reported profits. Interest expenses actually went up though by about $4 million. This is because they've been replacing older, cheaper debt with newer, more expensive debt, likely due to companies maturing older loans. Their income tax expense also went up, but their effective tax rate actually went down. That sounds confusing, but it's because they had certain costs last year that made their taxes look higher relative to their profits. Now let's hear from management themselves. They mentioned that trade tensions and tariffs are creating uncertainty. They saw a temporary boost in demand earlier in the year, but expects things to get a bit shaky with new tariffs coming. This means less new business and lower container usage. Their container utilization, which is how much of their fleet is actually being used, was high at 98.1% at the end of June, but it did dip slightly from the previous quarter. This slight drop hints that maybe things aren't as crowded as they were before. They just bought another company, GCI, for over $1 billion. This basically buys them a fleet of 500,000 containers. This is a huge growth move. Financially, they seem secure. They have good cash flow from operations, over $500 million in the first half of the year. Plus, they have access to a lot of borrowing power if they need it. They think they have enough money to keep things running smoothly. Let's talk about the risks. They're really worried about those tariffs and trade wars, especially between the US and China. They think these could really hurt demand for containers. Another big risk is not getting the full benefit from their recent acquisition of GCI. And in a really important point, they mentioned that since a subsidiary of Brookfield Infrastructure owns all their common shares, Brookfield's interests might not always align with others, like those holding debt or preferred shares. This could mean decisions are made that are good for Brookfield, but not necessarily for everyone else. These risks are pretty serious. The trade war stuff could really impact their business a lot. They're also concerned about something called onshoring or nearshoring of production, which might mean less international shipping. This report is also filed in a special format called inline XBRL to help computers read it. It's packed with detailed financial data that we've touched on. And finally, it's signed off by their CEO, Brian M. Sondhi, on August 1st, 2025. So what's my take on Triton International? They're a massive company in a critical global industry. They've been hit by some headwinds like lower lease rates and trade tensions, but they're still generating solid cash and making big strategic moves like that GCI acquisition. Their debt levels are high, but they seem to be managing it well with interest rate swaps. The biggest worry for their cutback and the potential for differing interests between their cutback and the potential for differing interests between their parent company and other shareholders is a red flag that investors should definitely watch. It seems like they are growing aggressively with that acquisition, but it's a careful balancing act between growth and managing those risk outs. The biggest worry for me is that concentration of credit risk and those trade war uncertainties. Having a few big customers can be great when things are booming, but it's a huge risk when they cut back, and the potential for differing interests between their parent company and other shareholders is a red flag that investors should definitely watch. It seems like they are growing aggressively with that acquisition. Alright, that's our deep dive into Triton's latest financials. What do you think about their massive acquisition and the risks they're facing? Let me know in the comments below. If you found this breakdown helpful, smash that like button and subscribe for more corporate decoding. And don't forget to check out our Discord community for more discussions and insights. Thanks for watching, and I'll see you in the next video.